kick off for our next panel discussion, we have Claire Colquhoun as our moderator. Claire is CEO of 8/8, our media sponsor. Prior to joining 8/8, Claire held several executive positions in business development, strategic planning, and finance in various blue-chip global companies. She is now going to introduce the panel and kick off the debate.
Okay, thank you very much. So we have kind of a tough job because we're the last people here and I have to make sure nobody heads for the door before we start. First of all, thank you very much to the London Business School. You've organised a fantastic summit today, and thank you very much to Breffney Gorman in the 8/8 team for all her help. It's an absolute pleasure as an LBS alumnus to be here moderating this panel. And I'm absolutely delighted to be moderating such an eclectic panel of industry leaders. I may find it a little bit difficult to be nice to Bruce over here, Bruce Steenson. Bruce is from New Zealand, I'm from Ireland. We had a bit of a fallout last Sunday, 22-24. We're still not recovered. But the subject of the conference today is not rugby, obviously, and not the All Blacks. But it is about frontiers, and the All Blacks are definitely in their own frontier. I think there were two very important points that I picked up in the debate so far today that we're going to pick up and run with, keeping the rugby parlance going. One was from First Reserve, when Claudie, the managing director, mentioned that it's going to take 5 times today's Saudi production just to achieve the incremental growth that we need from now to 2020. So that's the first clue that if we're not really in frontier territory, we better quickly get there. I think the second one is a point that I think it was also Claudia mentioned. He said that the next phase in innovation in the industry is going to come from collaboration with other industries. And that's something that we're going to speak to today because there is quite a significant amount of collaboration going on in the industry. And I think it's probably very interesting for the audience to hear about that. I think that often we actually only realize that we've reached a frontier when we kind of get to the other side. There's an island near Fermanagh where the G8 met this year called Boa Island. And there's a very old stone structure on it called a Janus head. So people who know the Janus head, it's a 2-headed thing with one head looking forward and one looking back. And often that's kind of what you need to know if you have gone to the other side of a frontier or not. You almost need to be looking back and saying, we did actually cross a frontier at that point. And so in 50 years' time, will people really be saying we crossed a frontier and that really was tight shale, tight oil, tight gas? Or was it just easy gas phase 2, easy shale phase 2? We don't actually know for definite yet. And probably if we were one of the 1.2 billion people in the world who are still without electricity, and we spoke about those earlier today, we would probably be sitting in this room saying, what frontier are you guys all talking about? You know, we have no electricity, we don't see any frontier. So I think as industry leaders, we have a huge responsibility to discuss and debate these subjects and to make sure that we are absolutely pioneering and getting to every possible frontier we can, because we have a huge ways to go still in the industry yet. So the panel today is going to share just some very simple insights on 2 broad areas. One on the technological front, the pioneering things and the breakthrough and the frontier things that we're doing. And the second thing is on the geopolitical front. And we're going to look at these from a perspective that probably didn't get a lot of airing yet in the summit so far today, is what's this doing to the economics of the industry and how is that changing and is it sustainable? So without further ado, I'm going to ask each of the panel members to introduce themselves, and then we will kick on to some questions. We won't do too many questions at the panel, and then I'm going to open the floor. Because there is such an interesting team here, I'm going to open the floor to the audience and let rip. So first of all, I'll just ask Anastasia to introduce herself.
Thank you very much, Claire. well, I'm delighted to be here, and I also mentioned to Claire earlier, I thought you guys have been a fantastic audience, very patient, and questions I thought were terrific throughout the day. My name is Anastasia Deulina. I am with First Reserve. I do work with Claudia Santiago as well. My background is in engineering, geology, investment banking, and subsequently to that, private equity. I have been with First Reserve for over 6 years now, currently responsible for international oil and gas operations here out of London.
Thank you, Anastasia. And Arild?
Thank you, almost correct pronunciation. My name is Arild Selvig. I'm with FMC Technologies, and I'm happy to be here to try to share some views from an oil service industry point of view. I'm a petroleum engineer by background, a long time ago, I would say, and with some additional business degrees from Norway and from the US. Been working for a long time on the E&P side, on the oil company side, upstream, along the value chain, and then jumped across the fence to the supplying industry with FMC, and never regretted that.
Okay, thank you, Arild. And Javier?
Yes, it's a pleasure to be here. I believe Statoil and LBS have a number of collaborations, including hiring some of you guys and also having a number of interns currently in our team working. So it's very good to be here and to having you as well in our company. Myself, I work in the corporate strategy, and I head up a team called Financial Projects. And what we do in our team, in addition to contributing to the development of Statoil's corporate strategy, is to look into financial and market trends and see how they impact our industry and Statoil. For those that are not fully familiar with Statoil, we are in 33 countries, and building on the more than 40 years of experience that we have in the offshore oil and gas industry in Norway, we are committed to accommodate the world energy needs, applying technology and business innovative solutions. Personally, I joined the company in 2006, and since then I've had a number of commercial roles in strategy, corporate finance, and business development. And before that, I studied my master, but it was unfortunately not at LBS. It was in Barcelona, decided. But we are making up for that, having some of you guys.
Okay, thank you, Javier. Yeah. And Bruce?
Good afternoon, everyone. It is also a very great pleasure to be here. And I won't talk about rugby a couple of weeks ago either, so I'll leave that out as well, which was also very close as well. But anyway, I work for Shale. I've worked for Shale for a long time now. I've worked in the upstream industry, primarily on the technical side in things like drilling, reservoir engineering, process engineering. And I'm currently leading our LNG program and our FLNG program. And we are trying to systematize the introduction of FLNG, particularly into global markets, with a view of designing one facility and then being able to learn the lessons and repeat them over and over again. So thanks very much, Claire.
Thank you very much, panel. Okay, I'm going to start with what I find one of the most fascinating developments that's happening in the industry, and that's the Prelude project. And some people in the room may know all about this, but Bruce, perhaps you can tell us a little bit about Shell's Prelude project. What was the genesis of it, and tell us a little bit about the economic case for FLNG.
Good, thanks. I'd like to talk about Prelude. But I've been involved in Prelude and floating LNG. Prelude since 2008 or thereabouts, which was about a year after we discovered the field, and then involved in the floating LNG part of it all the way through until after we'd taken final investment decision and the project well underway. So it's something that I'm personally, I feel privileged to have been involved in, because I think it is a frontier. It is moving. LNG production from being located onshore or stuck onshore, if you like, to being located offshore and able to pick up a whole lot more gas, which would otherwise be much more difficult to develop. So I mean, Shell's been in LNG for a long, long time. We've been in LNG for 50 years almost. We were in Azure in Algeria in the first commercial LNG development. And things have changed over time, consistently or continuously. Things have got better, things have got bigger. We're able to produce LNG cheaper, more easily, and in remote places. So the industry is growing tremendously. But in the mid to late 90s, it probably would have been, we looked at gas around the world and said, you know, there's an awful lot of gas out there that can't be developed at the moment. Wouldn't it be great if we could develop it with something that was sitting over the field rather than have to pipe the gas to shore? And at that, we started to work on gas FPSOs with a view to producing a floating facility. So that would have been the mid to late 90s, and then in early 2000s, we had a couple of opportunities, 2 or 3 opportunities to actually convert the idea into reality. But there was a financial crisis at the time which made things difficult. There were technical issues associated with one of the fields that we were looking at, and political issues associated with another one. So things got shelved in the early 2000s. But coming up mid-2000s, the market seemed to be changing again to get a strong demand for LNG. And then FLNG come onto the horizon once more. So it was about 2006, 2007 that we started to seriously look at FLNG again and produce a full design package for an FLNG facility. And then 2006, late 2006, early 2007, we discovered Prelude, which was a small offshore field about 475 kilometers from the nearest town, 200 kilometers from the coast, and the gas was going nowhere if it didn't have a new technology to develop it. So having started the development of FLNG again and then found Prelude and owning it or having equity in it at 100%, it was an ideal opportunity for us to go ahead with both the technology and the development of Prelude. The economics you mentioned, Claire, I think it's relatively simple. You do away with a facility offshore, compression offshore, long pipelines, shore crossings with dredging, shore crossings with rock dumping, and then a huge shiny facility sitting these days in a remote place onshore in order to produce the LNG. And then you create a breakwater, you create very long jetties in order to then export the LNG. And you replace that with one large facility sitting over the field, which the LNG carriers come alongside to take the LNG away. So cost is a big factor, but there are also environmental factors. If you're producing the gas through to a sensitive location, pipelines to a sensitive location becomes difficult as well. So Prelude was born out of that.
Okay, necessity is the mother of invention.
Yes.
I think what's fascinating with Prelude, when you look at the size of the Shell's first FLNG, it's the size of 4 football pitches on top from one end to the other, or bigger than that?
Yeah, it's about 477 meters long, so that's 4 football pitches, depending on what sort of football you play. But,
okay, we won't mention the rugby. Okay, so that's one fantastic and fascinating, innovative project that's underway. But technology breakthroughs like FLNG, they actually result from strong collaboration across the value chain in the industry. And I know that FMC is at the forefront of technological breakthroughs in the industry. So I think probably Arild can speak a little bit to the way in which FMC collaborates with the industry players. You know, is this through ad hoc joint ventures? Is it very structured? In particular, to speak to how he works with the Statoils and the Shells that are on the panel. Arild.
Yeah, I can do that. Hello, can you hear me?
Yeah.
Okay, I'm on?
Yeah.
Very good. I think we have numerous examples today that technology innovation in the oil and gas industry is really talking about sophisticated technologies that really needs long-term partnerships and commitments from many partners to get this off the ground. So for us, it's two dimensions. Is how do we organize R&D internally, basically in R&D hubs around the world, and also how do we work with our partners in order to get there. If you take the first point first, the way we structure the R&D on the subsea side within FMC is that we locate the R&D centers to where we have strong home markets. Typically, we will have one R&D center out of Norway, and of course focusing on what we do with Statoil. That is very much related to Arctic technology and technology driving remoteness, longer step outs. Then we have an R&D center in the Gulf of Mexico in Houston. That's where Shale is a strong partner to us in that area, where we basically do a lot of in deep water technology because of the features of the Gulf of Mexico. The final R&D lab we have in Rio de Janeiro, and it's particularly focusing on the needs of Petrobras, and that is very much related to the pre-salt technologies and heavy oil separation on the seabed. So that's how we try to organize and be close to the markets to really find the first movers and have strong partnerships in driving the R&D forward. And then about partnerships, I think for us it's key that we team up with our long-term partners when we do R&D. We are the sort of the experts in our area of expertise, if you like, but our partners, the big major oil companies or the IOCs, they have the needs in their portfolio, and it's really where you match the needs together with the cutting-edge technology that you really can get the right value creation, and that's an important thing. This is a long-term thing. It's not that you just jump on a program on R&D. You really have to learn what is driving the value on the customer side, and you mirror that with where we have our cutting-edge technology in our toolbox.
Okay, and I know that you're doing a lot of work with both Statoil and Shell, for example, in subsea technologies.
Yes, that's correct. And of course, I would say that Statoil has been extremely important to the development of FMC in the subsea area. We had almost a 20-year exclusive relationship driving the subsea technology forward in the Norwegian continental shelf. And after that, we've been able to take that technology through partnership with Shell and Total, take it to the international arena, and now delivering worldwide in West Africa, in Brazil, and Gulf of Mexico, based on that technology developed together with Statoil 20 years ago.
Okay. There's been a lot of talk today about shale, and don't want to overdo it, but the shale boom in the US has obviously been fueled by a very attractive investment environment, Anastasia. And I know it's a place that First Reserve would find as an attractive investment environment. But can you see any follow-on market that has anywhere close to the right kind of ducks in a row or the right investment conditions to enable it to also monetize its reserves?
It's a fascinating question, and I think we're all searching for that next market, which will be somewhat similar to US, and it's a tough one. We heard from a number of speakers today that geologically we all think that there is a number of places in the world where you can probably replicate some of the success story that really happened over the last, less than a decade in the States. There's a number of factors that are different, and I think from our perspective, one of the key success factors for any private equity venture is leadership and management talent. And that's where US really is doing extremely well. There's a proliferation of management teams where I heard someone said recently there's 600 management teams around Houston alone looking for backing. And that is very unique. There is a number of industry players like BP and Exxon that train people early on. They then move on and work for independent players like Apache and Anadarko and Devon. And after 15, 20 years experience, these guys are ready to go and start something on their own. And you do require a lot of energy and a lot of entrepreneurial talent to get something off the ground. And that's what, frankly, we're not quite seeing yet anywhere else. Yes, there is talent in Britain. There is absolutely no doubt. There's a lot of talent in Norway, and we're excited to potentially fund opportunities here in continental Europe. But in terms of the scale and ability to replicate it as quickly as has been done in US, I think it will be somewhat challenging.
Bruce, I noticed that Shell had invested about 24 billion in oil and gas in North America in Shale, but Peter Voser announced a strategic review of the US shale portfolio in August. Does Shell think that shale is a frontier too far?
No, it's not a frontier too far. I think in reality, it's a very early stage of development of the shale oil and tight gas business. If you look 10 years ago, the industry was busy building LNG import terminals into the States, and now we're trying to convert those into export terminals, and that's 10 years, and essentially that's driven by the shale revolution. So it is only 10 years old, and you've got to bear that in mind, and there's a lot of learning happened in that time frame, and companies like ours look at our portfolio from time to time and revise the portfolio on the basis of high grading, on the basis of what we see in terms of direction. So I guess what we're going through now is a high grading process to make sure that we're able to adapt to the changes in the shale revolution.
Okay, thank you. So Javier's been very quiet here, so I think we need to throw some questions his way. Statoil has a fantastic website where you can go on and they basically pose problems, and they just ask the market in general if you have any innovative answers to their problems, and they run all kinds of competitions for this. So Statoil is indeed a very, very innovative type of organization, and outwardly shows that it respects innovation. But they really topped it this week. Just a few days ago, Statoil and NASA announced that they are teaming up to see how knowledge and technology used for space exploration can be applied to the oil field. Javier, can you speak to what prompted the choice of NASA as the ideal collaboration partner? Is it in any way linked to understanding how remoteness is best managed, or what's going on here with NASA and Statoil?
Yeah, that's correct. So we sign and we form an agreement to explore how technologies and knowledge from the oil and gas industry and space industry could be relevant to one another. There is more in common on those technologies that we previously thought, as the industry has gone into more and more complex frontiers. And therefore, as we go into farther and farther frontiers, it's useful to collaborate on that. I think for anyone that has seen the movie Gravity with George Clooney and Sandra Bullock, it's obvious that it's a pretty harsh and challenging environment. So we think we could learn from some of the technology that NASA has developed for those environments and apply it in equally challenging oil and gas areas. We have a pretty good track record on innovation, and we are always looking for smarter, more cost-efficient and safer ideas. And collaborating with such leading institutions and collaborating across discipline is fundamental in getting those new ideas that are very much needed. So that's part of, that fits very well with our ambition on research and development and innovation, where we are currently spending almost $500 million.
Okay. And I know that FMC has been collaborating with NASA for quite a while, Arild.
Yeah, I mean, I think in general we try to learn from other industries, whether it's how do we manage our business or how do we do R&D or and we try to sort of steal with pride from other industries. As one part of that strategy is that we have recently employed NASA engineers into our organization, basically trying to do exactly what Statoil is trying to do, try to learn from the space industry and see how space engineers can really develop subsea systems far down on the seabed, including a lot of remoteness and automatic systems. And I would just add that I think in general we as an industry are becoming so complex that we cannot rely on that all the innovations and all the smart things comes within our own industry. So you know, a typical example, we as a manufacturing company, we try to learn from the car industry when it comes to manufacturing principles. We try to learn from the airline industry when it comes to application of composite material. And as you mentioned, we are also trying to learn from the space industry when it comes to designing equipment for remote operations.
Thank you very much. Turning to economics for a second. So the industry is changing radically from an economics perspective, but one of the continuing facets of the industry is the investment leakage that happens in large projects. So we have an industry now that's investing 650 billion per annum in new capital projects. About 67% of that is invested in the upstream sector. And I know if we look at our sister industry in mining, all four of the UK listed mining companies have changed out their CEOs in the last year, and I use that term generously. But the oft-quoted reason has been fears over capital discipline. So the mining industry has really been burned in the whole area of capital discipline over the last year. Javier and Anastasia, interested to get your perspectives. Is the oil and gas industry looking at a similar kind of fate, or is the capital discipline in better hands in this industry? Javier, what do you think?
Sure. So let me first maybe address the profitability of the industry, and then secondly make some comparisons with the mining industry. What we see, I mean, in Statoil case, we've managed to grow our production over the last decade significantly, and just between this year and last year, we grew it 6%, adjusting for other things. But if you look at the IOCs and the majors as a group, what you see is that this was the 11th quarter where their production has gone down. If you look even a little bit farther over the last 10 years, what you see is that production for the major companies has barely grown 2%. And in the meantime, what has happened is that they have spent 4 times more. So what that really means is they are running faster to stand still. It is also true that the oil price has gone up, but it has gone up around threefold over the last decade only. So, but oil and gas companies have not necessarily captured all of that. What you see is that on relative basis, net income versus what we get versus the Brent, we are actually getting less. So on absolute terms, we are only getting double, even though we are investing 4 times more. So what that really means in terms of return on capital employed, which is a key metric that our industry is measured on, is that now we are pretty much near a decade-low return on capital employed, which is a bit worrying for investors in oil and gas companies. Also, if you compare with 2003, where the oil price was $30, it's pretty much the same return on capital employed. So you could argue from that perspective that $100 is the new $30. If you look at the broader value chain, what you can see is that this is not only true for oil and gas companies. I mean, you would expect some suppliers to have also, of course, benefited from higher oil price, which they have, but not radically. You've seen, for example, some of the key suppliers like Saipem, Aker, or a few weeks ago, Petrofac, that released some profit warnings. And you saw their share price going down like 15%. So they are also having their own challenges on execution and cost, etc. So So I think what we need is obviously to collaborate together as part of the value chain, because this is a challenge which is true for the value chain. I think there is more need to focus on efficiency. One of the examples that we have in Statoil is this fast track project that we started in 2010, and basically what it is looking at small oil and gas field developments in Norway and seeing ways to develop them faster. And all in all, they've added around 100,000 barrels, and what we've managed to achieve in some instances is through standardization, reduce the development time by 50%, and then also reducing the cost in some cases up to 30%. And I think we need a lot more of that, obviously in Norway, but all around the world. And then finally, I think technology is quite critical, as we were talking about. We have, for example, a department in Statoil and the research and development team, which looks into frontier developments. And what they do is looking at how to develop the next set of projects. And their motto is how to make the impossible profitable. So I think when we develop technology, we will need to have that very much in mind.
Thank you so much, Javier. Anastasia, do you have any private equity perspective on the economics of the industry at the moment?
Sure, I'd be happy to. I'll echo Javier's comments on profitability. It's not just an issue for big oil. It's very much an issue for independent players as well. And for a while, the mantra has been grow for the growth's sake. And a lot of independents achieved 15, 20% rates of growth year over year. But frankly, none of them are cash flow positive or even cash flow neutral. As prices in US have gone from $30 in 2009 to now we're sitting close to 100, a lot of that profitability has been really taking the backstage, and a lot of people were trying to just grow. This becomes an issue, and I think it will become a bigger issue if prices in US, as some experts predict, will start decoupling from the Brent pricing. We're already seeing very wide differentials. If you look at Bakken, for example, in North Dakota, we're seeing in excess of $20 per barrel differential relative to WTI, and that is projected to grow. Even though shales are a very fantastic resource, but they're not equal. There is a good acreage, there is a fantastic acreage, and there is a very average acreage. And people who are the best in class in terms of their profitability and their returns are ultimately going to be at the very top. From the private equity perspective, we're growth equity shop, a company that I'm involved with, for example, Mid-States Petroleum, which is a public company in US. When we bought it from a family in 2008, our capital budget was $16 million, 1/6. 2013, our budget was $600 million. So you can only imagine the degree of change that the entity has gone through in a very short period of time. And that creates a lot of need for learning and a lot of need for continuing perfection, if you will. And without it, we are not going to succeed. And I think a lot of our peers will see similar situations with their portfolio companies as well.
Thank you, Anastasia. I've just got one last question for the panel, and then I'm going to throw things open to the floor. And it's really for anyone in the panel who has an interest in this. In a 2007 report, The Rise of Asia's National Oil Companies, one of the main findings was that the Asia national oil companies at that stage didn't pose a threat to the international oil companies. That they were at the top of the food chain due to their technological and managerial expertise. So the question to the panel, to my colleagues on the panel 6 years on, is this still the case? Bruce, do you maybe want to throw in your 2 and 6 on that?
Yeah, I wouldn't say that the national oil companies are a threat. I would say that they are very good partners for us, in that, we've been partnering with Asian national oil companies for a long time, particularly in Malaysia and Brunei, and growing up with them. Petronas, we've worked with Petronas decades and decades and decades, almost 100 years. Yeah. But that partnership has grown to the extent that Petronas are now running their own facilities. So recently Petronas kicked off and added another LNG train to the Malaysian LNG facilities on their own. Petronas has just started an FLNG project, a small FLNG project. So that means that they are developing the technology, developing the capability that makes them good partners to continue to work with. We partner with PetroChina a lot. We're investing with PetroChina in a drilling services company to build and provide small rigs to shallow onshore drilling. So we provide some technology in there. PetroChina provides technology. PetroChina provides a manufacturing capability. And together, we go ahead stronger. So a threat? No, I don't think a threat. I think just valuable partners.
Okay, Javier?
Yeah, I think broadly speaking, Asian companies and the Asian economies are catching up with the Western economies and Western companies, and the crisis has just accelerated that in general at the macro level. I think at an industry level, I think the oil and gas is quite peculiar in the sense that quite often you have the same company, and sometimes they are their client, they might be buying your oil and gas. Sometimes they are your partner on developing a big project, and sometimes they are your competition when you are trying to get attractive acreage. So the dynamics there are quite interesting. I think, for example, if we just look at from an M&A perspective, they've become more prominent, and there's no doubt about that. Just over the last year, around 30% of the acquisitions were done by Asian companies.
Wow. Okay, thank you very much, panel members. Just going to throw things open to the floor, and happy to take any questions at all.
I'm Andy Callis. I'm a journalist at Reuters. Just before the panel started discussing things, Andrew Gould was talking about QCLNG. We've heard Prelude mentioned. Since I've been here anyway, I've not heard mention of Browse, another big LNG project, or Kashagan, a big oil project in Kazakhstan. Those two projects, the cost overruns were even more dramatic, and I don't think Andrew Gould would be disagreeing with me if I was to say that QCLNG's cost overruns were fairly dramatic for BG itself, and came close to causing a bit of a major wobble when it came to shareholder confidence. So, sorry, this is rather a long intro to a question, but is the scale of projects now so huge that they have the ability to actually bring down some big companies, possibly, obviously not Shell, way too important, but of the scale of Shell, perhaps? And what does that mean for return on capital employed in the future? Are the big oil companies being forced into these bigger and bigger projects, and are they riskier and riskier investment?
Okay, that's a fantastic question. I'm going to throw Bruce in the deep water here.
Thank you. Was it Andy, was your name? Thank you very much. No, I think it's without a doubt, our projects are becoming more challenging. Our projects are becoming in deeper water, in more harsh environments. They're becoming more complex. Kashagan, you mentioned, a hugely complex project technically. So managing those projects is becoming more and more difficult, without a doubt. The cost overruns that you referred to, are they a result of the complexity of the projects, the fact that we don't understand them well enough when we go into them? I think if you listen to IPA, Independent Projects Associates, they would say yes. They would say that we are not doing enough front-end loading prior to getting into projects, which means that as an industry, we are performing badly with mega projects. I think IPA published statistics that would say that something like 60 or 70% of mega projects fail. And their argument for that is purely the front-end loading. They also argue that the projects, the size of the projects that we get into, we're not well enough prepared in terms of our integrated teams. We need more and more people to run the projects, and we're not integrated enough and not aligned enough with those people to deliver the projects. So my response is, it's getting more complex. We simply have to rise to that complexity challenge. You mentioned Browse, so I'll use the mention of Browse to get a plug in as well, in that Browse hasn't taken FID yet. Browse was a project that's been run by Woodside as operator, and we're a partner in that. And they were looking at an onshore development, an onshore LNG development, and it did simply get very complex, and the cost estimates were showing it to be very expensive. And if you then look at the alternative, which is a floating development, it starts to become quite attractive. So the Browse joint venture has now switched from the complex offshore-onshore option to a multiple FLNG option, and they're currently doing the first stage of engineering for that prior to working up to an investment decision. So the learning I take from that, and maybe from a biased position, is that they are able to build on what we're doing for Prelude and then standardize their offering to be able to put 3 more facilities over Browse, getting confidence from the delivery of the first, and then, as Javier referred to, standardizing to be able to deliver subsequent projects with confidence.
Thanks, Bruce. I think Javier and Arild are both interested in speaking to your question as well, Andrew.
Yeah, I think that's a big focus of the industry right now. I mean, and it's the nature of the industry. If we just look at our own Statoil's capex, we are investing a record $19 billion, which is as much as we've ever spent. And if you put that just over the next 4 years, what it means is that we're basically betting the company, so to speak. We're spending around $80 billion, betting without meaning in a risky way, but we're investing for the future around $80 billion roughly up or down in the next 4 years, which is pretty much the same as the value of our company. So that's how capital intensive the industry is. But I believe that where we are going is a place where there is a lot more capital discipline. You've already seen companies like Exxon, like Total and BG saying that over the next 1 to 2 years they are going to reach a capex peak. Where that might lead us afterwards is yet to be seen. I mean, there are many of the drivers that have made that increase over the last few years in relation to inflation that might still be there on some segments. But then, as Bruce was mentioning, it's a lot about higher activity and higher complexity of where we are going. So we'll see how that is managed. But I believe we need to build on what Bruce was explaining and use technology, efficiency, and collaboration to cover that.
Okay, and Arild?
Yeah, I think that's a good question, and I think it's fair to say that these projects that we are currently seeing in the oil and gas industry are massive projects, very complex, and of course, with that carries a lot of risk when it comes to overruns and financial risk in general for the oil companies. I think also that back to what Andrew Gold talked about, what can BG learn from Slum and vice versa. He talked about that the oil companies are very much concerned about the risk management, and I think this fits very well in. It's an increasing economical risk of running an IOC today. In addition, you have the political risk dimension, which is also increasing. All the hydrocarbons are more in the nasty parts or in difficult parts of the world. So you add the political risk and overall, so the risk management piece of the E&P business is increasing. And what we see on the supplier side is that this risk thinking drives cost back to the diminishing return of the IOCs, because you get more and more specs into the equipment that drives cost, drive the cost of the equipment, drive the designs, drives the number of engineering hours to get the products out in the marketplace. So we are sort of in a catch-22. The industry has increasingly risk level that drives cost, that drives diminishing return. So it's going to be interesting to hear perspectives of how we can break that wicked circle.
Okay. Andrew, did you get an answer? Yeah. Okay, thank you. Question, the gentleman here with the grey jacket, blue shirt.
Thank you. I'm Alex Lopez. I'm a LBS alumnus from TGS. So it's to build on Andrew's question. So you mentioned the risk. To my understanding, at the moment, the risks are really carried by the operators and not the service providers. What do you think about trying to share the risk between the operators and their contractors, i.e. the service providers, and probably trying to involve the service provider more upfront, probably before FID, because these service providers are the ones who carry the technology and the development. They probably provide quite some good insight about how to develop the project and how to probably make it more efficient and more leaner.
Okay, good question. Anastasia, would you like to speak a little bit to that?
Sure, I would be happy to. I think the key characteristic of our portfolio, and I'm talking now about the total portfolio first reserve, which is exploration and production, equipment and service. What we encourage is collaboration and cooperation amongst those companies, and I think that is a very big emphasis of the firm, is to ensure that those risks are properly controlled and also that there is a proper segregation and separation between the risks that are going to end up with the E&P part of our portfolio versus the equipment and service. So there are some risks that absolutely could be managed on both sides, although they will still be a number of them, as Andrew was saying earlier, that would be very unique to E&P, and they will still reside with E&P no matter how you ultimately cut it. So I think, yes, some of it could be managed, but I think, again, the E&P portion of your portfolio will still remain riskier, and therefore the return expectation for the E&P piece of the portfolio will be higher.
If I can just add one point in that, I think a lot of the balancing of the risk happens through the contracting strategy, and there's an increasing move towards EPCM type of contracting where even more of the risk is really sitting with the owner-operator, you know, and that's just the nature of the industry at the moment. But I think the contracting strategy is a key way to figure out the correct balance of risk, and at the end of the day, the risk should really sit with the entity that's best placed to manage it. That's the way to keep it from getting out of hand. This gentleman here. Yes, Antonio.
Hello, my name is Lucas Iomas. I'm a first-year MBA student at LBS. I'm a chemical engineer and I've been working in the downstream oil and gas sector. I want to go back to the answer of Mr. Steenson about the relationship between IOCs and NOCs. Someone could argue that the only reason that the IOCs still exist is that they haven't managed to the NOCs haven't managed to develop the technologies yet to dominate the world. In the downstream oil and gas industry, we have seen that generally the landscape is changing due to the fact that the NOCs have managed to develop these technologies these days. To give you an example, to get in the downstream oil and gas industry in China is becoming extremely difficult due to the fact that technology from the West is not needed anymore. Do you believe that we are going to see that in the upstream part as well in the future?
So thanks for the question. If I just repeat it back to you so that I understand it, it is basically, do I think that the NOCs won't need technology from independent companies in the future? that they will be able to develop their own. And if that's a question, I don't think that's ever going to be the case. I think even if you look at a company like ours, you can't develop the technology on your own. You've got to partner with people. You've got to use what is available globally in order to meet the challenges that we're facing globally. So the NOCs, just as much as the IOCs, are going to need partnerships in technology and business partnerships and innovation in order to be able to develop the more challenging hydrocarbons that we're forced to develop as we go along. So are we redundant? No, but we have to innovate. We have to keep innovating to drive our case.
Thanks, Arild. I think both Anastasia and Arild have an interesting point to make. Anastasia?
Just a quick comment back to the shale in U.S. issue. It's really independents who made the shales work in U.S. It's not even the international oil companies. It's not Exxons, Chevrons, or Marathons that made it work. It's the nimble operators that ultimately made the revolution. So back to your question on, where is the bright line and where would the technology transfer stop? I think you need all the participants in the chain to make the sector work.
Arild?
Yeah, I think we may do a mistake if we put all NOCs in one bucket. It's a great variety when it comes to capabilities and skill sets within the NOCs, all the way from Statoil, who's an NOC, and Petrobras, to the more kind of consanguine kind of NOCs that you see in West of Africa. I think that the IOCs may be challenged by some NOCs, and that's the NOCs that sits in the middle. And two typical examples of that is Gazprom and it's Pemex in Mexico. Those companies, they have strong technology ambitions themselves. They have invited the IOCs in, like in Russia, for capital, access to capital, like on the Stockman field. But basically, they want to engage directly with the main technology suppliers, like ourselves, FMC, and other kind of turnkey technology providers. So I think that at least in the middle segment, as I call it, the IOCs may be challenged on the fact that the NOCs will like to work directly with the turnkey technology providers.
Okay, gentleman here. Yes.
Yeah, hello. It's Mike here. I may build wind farms for a living today, but going back a few years, I worked for BP. I'm actually a geologist as well, so I worked in E&P. Looking at the frontiers of oil and gas, we've had 2 or 3 speakers today highlight the scale of the challenge and the search for 5 new Saudi Arabias and LNG to boot as well. I mean, moving away from technology and project management, I guess the question is, where do we see these volumes coming from? Australian LNG, Australian gas is full. They're worried about domestic shortages. Philip Gould thinks that shale gas, from what he was saying, isn't exportable in the sense of the rapid growth of outputs that we've seen in the US to other parts of the world. West African LNG, sorry, East African LNG gas, yeah, I concur. I spent time down there. That's a long way away. But the scale of the challenge and the need for increased volumes is relatively short term.
Okay.
The next 10 years, we need to be pumping more gas and pumping more oil. So looking to that frontier, where does the panel think these volumes are going to come from?
So geographically, where is it going to come from? And also from EOR and other techniques, where are we going to make it? So, Javier?
So I can comment, but from a Statoil perspective, and when it comes to exploration, where we have tried to expand our resources. So we've been fairly active in the Arctic. Of course, the Arctic is you cannot put all of that in one basket. But for example, we've discovered this year one of the largest discoveries in Canada East Coast in Bay du Nord. So we've discovered there some between 300 and 600 million barrels. Then in the Norwegian Arctic, in the Barents Sea, we've also discovered not long ago Johan Castberg, and that's also adding some between 300 and 600 million barrels. And then you obviously have East Africa, which is much talked about, and we've done there a number of discoveries in Tanzania that we think can add up so far between 15 and 17 TCF, which is a pretty significant amount of gas. I think an underdog perhaps is also existing areas, and what I mean by that is, for example, we've discovered in Norway, which everyone thought was declining and mature by now, Johan Sverdrup, which is yet to be properly appraised, but it could have up to 3.3 billion barrels, and that was next to many other mature fields. So there is more than people think in some of those places. And then the last point as well is EOR, which is on mature fields. Just a few weeks ago, for example, we have the Statoil, the Statfjord 8 platform, which is one of the oldest platforms in Norway. It has been operating there since '79, and initially the recovery rate expected was 40%. I believe now it's closer to 64% or so, and the ambition of the group of companies is now to increase that even up to 74% recovery rate. So I believe EOR can also be a big enabler of that growth.
Bruce?
I would probably add, I would endorse what Javier was saying with respect to near fields and near existing infrastructure, smaller accumulations, things that are more difficult, have been more difficult in the past, the EOR side of things. I think you didn't specifically mention deep water, but we are continuously moving into deeper water. The volumes will be found there. I think the IEA estimated that we've got about 200, 250 years of gas available at current production rates. So it's there, it just becomes more and more difficult to get it, and we've got to be more and more cleverer to recover the last or the smaller pieces of it.
Thank you very much. Any other questions? Yes, this lady.
Yes, hello, my name is Bodil, and I'm currently following a master program at SOAS in global climate and, global energy and climate policy. 3 weeks ago, the climate summit meeting in Warsaw ended, and sadly not with the results some of us had hoped for. So I was just wondering, we cannot really discuss energy without discussing the climate. So considering you are representing, oil and gas and the private sector, how do you see your role in trying to sort of reach the end goal of less than 2 Celsius degrees warming?
Thank you for that question. Yes, we of course have to touch on climate. Arild?
Yeah, I can at least start. First of all, before we leave the resource, add the question that was previously. I think that the resources has to come from multiple sources that we talked about, but the general message is that it's going to be more difficult resources to get out. So technology innovation needs to drive that additional production that was talked about. I cannot see any other way, whether it's deep water, whether it's harsh environment, Arctic, undersea, or IOR, it's technology that is at the heart of that drive. And then to the question about how do we see oil and gas industry play a part in the environmental challenge we all face. As a supplier of subsea equipment, we have been involved in some national studies in Norway where we have looked at different kind of field development options that would shape the carbon footprint of that development, both looking at the capex side, i.e. the development side, and also how do they, what is the carbon emissions during operation of the field. And what you see is that the subsea equipment that FMC is producing and selling has a benefit in the sense that it reduces the carbon footprint, particularly in the operation phase where you have no surface facilities, you have no logistics, you have no emissions to air or to the sea, basically bringing the production directly on shore for final treatment. So at least I think our technology, in a sense, could be applied to develop more environmental friendly solutions than a platform surface-based kind of development.
Okay. Anyone else want to speak on the climate question? Bruce?
I would simply say that I think everybody's got a role in the problem, and companies like ours are striving for more efficient ways to produce energy and lower carbon energy at that. And we see gas as a significant part of that going forward. So it's up to us to strive for greater efficiency. We need to work together with governments and multi-government organizations in order to then drive the whole economy to accept the higher cost of that as well. Yeah.
Thank you. Gentleman down here with glasses. Removing the glasses.
Thanks, Manjit Sajadi, LBS. Could I hear the panel's view on the latest of the frontier states, the Iran situation?
Okay. I didn't hear a question. The Iran situation.
Well, the potential as the
potential.
peace dividend.
Yes. Anastasia.
I'll chime in. We spend quite a bit of time, obviously, thinking about political implications of what's happening in the world on our business, and we view that as we view this as a positive development, but at the same time we're careful about implications for our portfolio companies with respect to oil price and what that means for U.S. pricing, what that means for the rest of the world. We are already seeing a decoupling of prices. As I said earlier, this will probably facilitate that decoupling even more. And as a result, will drive us towards decisions that may guide us more towards investing internationally as opposed to investing domestically. A lot of capital flow in the oil and gas industry is dedicated to North America for various reasons. It's a politically stable region where, on a risk-adjusted basis, people have seen fantastic rates of return recently. But if we can get more comfort that politically the rest of the world will be a better and more stable place with growing demand and oil that's now not going to flow to North America, this might create a lot of opportunity for us. So we see this as an opportunity, bottom line.
Okay, thank you. Any other questions? Gentleman over here. Smiling.
Jerry McGurgan, 8/8, and that's the first time Claire has ever called me a gentleman. Given the reserves are located in the frontier developing countries, can the panel comment on the challenges they're facing or will face with the local content demands that are placed on them? Why I asked that question, we're currently working with a company, oil company in West Africa, that basically have been blocked or prohibited in using the partners of choice because of the production sharing agreement.
Bruce?
Maybe I could open and make a couple of comments. I think that wherever we work, we need to offer a full value proposition. So very often local content is part of that value proposition. The government, yes, wants energy developed, but wants development for the country as a whole. And we need to recognize that and work within that environment. The big thing, though, is to work within a stable environment and know what you're getting into up front and be able to make your investment decisions on the basis of that. And if the rules and regulations are clear, then everybody knows the game, and you play it as well as you possibly can so that everybody wins.
Yeah, I think, for example, Norway is a great example of how before there was oil, the industry was not as strong as it was, but the government took a holistic approach and developed a national company, but it also made a strong effort to make sure there was a whole industry attached to it. And then now you have large Norwegian international companies that are leaders in their areas. And Norway is getting as much revenues from some of the related taxes as it is from the fact that there is almost a fully employed market with fairly decent salaries working on the industry. So I think it's fair for other countries and societies to have that ambition. So I agree with Bruce that there is an expectations from us also to have a value proposition to those resource holders, to not just exploit oil, but offer a lot more than that.
From a supplier perspective, Arild?
Yeah, sort of from the supplier side, you know, we have some very strong international markets that local content is a natural part of our contracts. One is Brazil and one is West Africa, and the way to manage local content is you need to have a long-term perspective, and you need to find local partners, that is your cooperating partners in good and bad times, develop the capabilities step by step, and gradually lift over more and more complex work and engineering tasks to the local partner, and then step back and do less and less as part of the international scope. And how do you manage that transition is really one of the key success criteria for a company like ourselves. You cannot take too much risk, because then you will end up in a difficult situation towards the end client. On the other side, you are pushed by the national authorities to do a bit more than you are comfortable doing. So local partners and capabilities is the key, and you have to then develop these capabilities in a controlled manner, so you do more in the next project than you did on the previous project locally.
So it's a gradual response.
Yeah.
If I can make one more comment, Claire, sure. In building on what Javier was saying with respect to Norway. Norway is the outstanding example of local content, where the Norwegian government created incentives for developing local technology and local opportunities, which then enabled the international companies to partner with locals and everybody building from it. So it's an ideal model to follow.
It's the leading light, I think, in the local content. Any other questions? One, two. So, gentleman here, and then, sorry, this one here then.
Hi, it's Peter Sherry here from Redpoint Energy, a consultancy. My question is to Bruce, but also to the panel. It's on CCS. We heard from Christoph earlier when he went through the global survey, and he indicated that top execs responding to the survey was seeing CCS as sort of, as he described it, dropping off the map. Just wanted to get your perspective, Bruce, on CCS and how that may play a role in future, if so, over what timeframes, and technically, what do you see as the key challenges there?
Dropping off the map, I wouldn't say it's dropping off the map. People are investing significantly with respect to developing pilots. We're participating in a pilot here in the UK to gather carbon dioxide and pump it offshore and re-inject it into Goldeneye, for example. So pilots are progressing. In Australia, we're participating in the Gorgon project, which is going to be probably the largest CCS project yet, injecting a lot of carbon dioxide coming from the reservoir fluids, which makes it a lot easier. So technology for CCS is easy, or relatively easy, when you are extracting the CO2 from a reservoir fluid and then injecting it. All you have to do is find an appropriate place to inject it, and that's not straightforward. I see it as a part of the industry going forward. I see it as a key part of managing our carbon footprint, but it's not a panacea. It's a part of, and it's going to take still quite a lot of investment to find the traps, to prove the traps, to find the technology to extract the CO2, particularly from combustion processes, and then economically inject it. It's then going to take innovation in the business environment to find the appropriate people to pay for the injection, to be able to spread the cost of the CCS.
Yeah, I think just to add to that one, we're still in a situation where CCS-enabled coal-fired plant costs something like 76% more than without the CCS. We've got a ways to go in terms of figuring out where the subsidies are to make that part of the industry grow. There was a gentleman over here with a question. Yeah.
Hi, my name's Omer. I'm a Master's in Finance graduate. Just a quick question. In regards to the banks being inhibited from being involved in owning any of the commodity assets, what impact do you see on the sector as they pull back or that's negotiated, along with potential impacts on forward pricing of oil, on which all of the projects' NPVs are calculated?
Anastasia?
Look, it's a great question, and I think the reality is the market in US again is very different from the market internationally. Project finance market that largely funds projects, offshore, is not existent in US. At the same time, the revolver-based facilities that are predominant in US are very unique. And those types of financings, they go both ways, and banks adjust their price decks, constantly. As prices fall, some of that funding will go away, and people will struggle. As I mentioned earlier, shale is not equal, and the ones who have the best acreage will continue to perform well. The ones who don't will have to look for alternative sources of funding, and it will be expensive. Revolver pricing right now sits around 300, 500 basis points, and that's not going to go forever.
Okay, I think maybe one last question, if there's anything else. And you've been a very patient audience. Thank you very much. Or maybe there are no other questions. Yeah, okay. Oh, one last question, yes.
Yeah, thank you very much. Just a very quick one. So we will believe Prelude LNG will be a good success, and also Browse will be. And at the same time, we realize it's in a benign area, it's near the equator. So in the future, I would like to know what's the future direction of the development of floating LNG? Will it be in some Arctic areas like Norwegian Sea, Yamal Peninsula? Or will you increase the capacity of the floater from 3 MTA to 9 or over 10 MTA? Yeah.
Okay, that's definitely a Bruce question.
Thanks for the question. First of all, I don't think Prelude and Browse are a particularly benign area. They are in cyclone-prone and designed for 10,000-year weather events, which means designed for 300-kilometer-an-hour winds and some pretty severe sea states. So not benign, at least not all of the year. Where do we go in future? I think, yes, we go to larger facilities. We are currently in Shell designing a larger facility for lean gas, for gas with low liquids contents. And that's becoming mature, and that will be hopefully the next cab off the rank. Into more severe environments, you have to look at offloading, and a partnership that we have with FMC is to look at an offloading system for very severe weather environments, and we think that's mature now, so maybe in more severe sea states. Arctic, that's a possibility. It will require, again, thoughts with respect to how you evacuate the LNG, how you keep the facility ice-free, and how you get carriers in, and probably, again, need a different offloading system for that. But yes, we will move bigger and we'll move into more extreme environments.
Okay. So I wonder, are we going to ever have any football games on the 4 football pitch sizes on top of Prelude? Well, all that's left for me to do is thank the panel. Thank you very much, Anastasia, Arild, Javier, and Bruce. It's been an absolute pleasure and a privilege to be your moderator. Thank you very much to the audience for being so patient on a Friday evening and for all of the very interesting questions. Okay, thank you.
So thank you, everyone. Thank you, Claire, and the panel. This part is not one we looked forward to, as we planned up for the last 6 months. And this is a sad bit when we tell you that the event's over now. And I'd like to thank you, the audience, for your patience and your participation. We hope that you've had many good insights and into the frontiers of the future of energy. Hope you've had the chance to network, make some new contacts, and hope you've enjoyed the hospitality we provided here and the beautiful venue itself. I'd like to thank again our platinum sponsor, BCG, gold sponsors, FMC and Statoil, and our silver sponsors, Yingli, Solar, and 8/8, and also our media partner, EIG Group. So thanks again to the speakers, London Business School for helping us organize this, giving us advice throughout, and finally, the committee. Without them, this event wouldn't be allowed. It wasn't just the two of us. We had a bigger committee. Tell you that we have networking drinks happening till about 5:30, so just over an hour. We have beer and wine and orange juice and water and what have you. So please help yourself to, as you head over to the Bishop Partridge Hall, the one with the green carpet, where we had lunch, and we will have our networking session there. And that's the remainder of the committee coming up, so once again. So we'd like to say thank you very much. That's the 10th annual GES done.